Hello algo maker, how are you? I hope you're fine. So in this video I will show you how I made almost 20% of return since March 1st of 2024, and as you can see below we are in 28th of December of 2024. So it was like 9 months of trading on this account, and we had like a drawdown of 6.39 and $34,000 on profit, as you can see here. And for the Christmas, I can just cash out almost $25,000. And I'm not sure if you are familiar with prop trading firm, but this is a funded account. It's a real challenge that I made, and now it's a funded account. And we know that is not an astronomical return. That's because the prop and trades firms are very restrict with the rules and the drawdown limits that you can have on a funded account. So I have to play safe all this period to make a good return. And as you can see, it was like a good performance. 188 trades here. The winning percentage between longs and short trades was like in a medium about 55%, right? We had a profit factor of 1.53. This means that each dollar that I lost on this strategy, I made 1.53, right, cents. So that's a good ratio to have. And now, as you can see, it's very easy to look this curve and say, okay, it's a good strategy, oh my god. But imagine that you are just turning on a robot, because this was not manually traded, was fully automated traded with expert advisors and quant trading methodology that I will show you how that works and how can you use this for you. But first, as you can see, it was like almost 4 months with not good results after the system starts to showing its true edge on the market with the trading strategy that it's using. So not good months, after that 2 good months, and then again a bad month, and now the last 3 months was very good. Okay, so first I need to explain to you that I'm not a normal trader, because I do not spend my time looking at the charts, right? And now I explain how actually this occurred, because very normal we see on the internet a lot of trading gurus showing the Ferraris, the Bugattis, and saying that you can make money on the markets. But let's face it, trading is boring, right? Trading is boring, but the process of you like dominate the boring process is the key to you actually have a results like this for your own account. Okay, and I'm pretty sure that someone will watch this video and say, okay, I can make more money than this in the same period. Nice, but I'm not here to say this is the golden rule for trading, all right? But if you compare 18% in 90 months with Warren Buffett that made 20% average on year, I'm pretty good performance, right? I have a pretty good performance. And this is only one account that I mentioned. So there's a lot to show you now. First, I want to explain what is the quant. What a quant do, right? When you say quant, normally people think, quant is like a nerd, like an engineer or a math specialist, or I don't know. Picture that what quant means to you. I think this concept, these names will come into your mind. But basically, I'm in this industry about with 10 years, right? I'm 10 years. I work with banks in Latin America. I work with hedge funds. I provide software development for trading firms, and I'm here to like summarize all the concepts that you had about quantitative trading, and resume that for quant is basically uh, modeling, right? Risk, risk, and return. Basically, that's what we do. Okay, we just modeling risk return, right? Why modeling? Because risk return is very subjective to the person that are operating, right? A trading system that works for me may not work for you, because your risk profile is different than mine. So basically, when you have a quant with you, or if you are a quant, you are very good to modeling risk return, because this is equal to expectations, right? Expectations, because you know that the expectation, what generates frustration when the expectation, the results, and if the results are below the expectation, right? This is equal frustration. So we as a quant are very good to manage that expectation because we work with modeling, right? Expectation. So how we do this? We use data. Okay, you use data to modeling this risk return on strategy. So now I'm going to show you how that actually works. Okay, what normal traders do? Normal traders, go to the this is the real account, the real accounts that I was showing to you, right? And in my MetaTrader, okay, we can see all the trades, the historical trades are here in my chart, just to show you that it's indeed logged in here in my PC. But what I want to show you is like this. This is the chart, right? Normally, people that work with technical analysis, they put like this. They put like trend lines and try to know, are you going to use some methodology to predict markets. Okay, it might work, but what we do is different because I'm not sure if you are familiar with the candlesticks, but the candlesticks, if I put the mouse here, let me put the mouse here. As you can see, if I stop on a candlesticks, it show me information like open, high, low, close of of this candle. So this is a weekly chart. So each candle is a week. Inside this week, I have the open, the high, the low, the close price inside this week. And if I go in the minutes, inside the minutes also I can have this type of data. So we as a quant, we use a APC, right, to do this. Okay, we take the chart data, right, the price of the candles, every information that the candles and the price action do for us. We run this inside a neural network with data mining process to look for setups to good strategies that are validated on historical data. And if this strategy is good, we go to the next step because it's very easy to validate strategy doing back tests. Okay, in the past the strategy is good, but we have to do another test like robustness test. There's a lot of ways to do robustness test to stress the model to see if in the future, because the future is not equal to the past, our strategy can handle this randomness of the markets. So one example of robustness test is Monte Carlo simulation. For example, we have in this line blue was the original performance of the strategy, right? And we can just run a Monte Carlo simulation and see the like a multiverse possibilities of the outcome of the strategy if things were different from the backtest that originally we had. So this gives us an idea of other other situation that our trading system can need to confront in the markets, right? Because the markets are dynamic. Okay, so basically what does this show to us? After we stress a model and we see that this model is strong enough to support the randomness of the future prices of the markets, now we are able to run it on a real account with small sized lots, right? I will show you, for an example, this strategy that I showed that was operating on real account since March. Let's highlight the monthly return, right? Let's highlight the drawdown. As you see, the maximum drawdown was in 7 June, right? 6%. And let's highlight also the winning percentage on longs and shorts. If you sum and divide this, we are gonna end with more or less 55% of winning percentage, right? And the profit factor of 1.53. Okay, I'll highlight this point, and now I'll show you this. That was the Monte Carlo and after the validation, the stress test and everything. This was the my reference, my statistical reference of the strategy before I run it on the real account. As you can see, my winning percentage was very close to the real account. My profit factor now is a little bit higher, but not that much, right? I expected 1.446 of profit factor, and I'm having 1.53, and I had a drawdown maximum of 6%, right? and we just hit this 6%. But in this test, if you see the value of drawdown is greater than 6% because the account is 200K. So this 21 is like greater than the 10%. It shows 6% of drawdown because the account was on profit when the drawdown occurs. So basically, this is the main reference statistical, and the real account we see that's very close, very similar. That's because I did a lot of robustness tests. That's why, because I use a lot of data mining process, a lot of filters to have this strategy built. So basically, I want to show you that after this we kind of have like a reference, like we are not blind with my strategy on the markets, to see if I'm profitable in the first day or in the first week, because as I said, was long 4 months and I had to believe in the strategy, right, before the edge comes and showing the account results. But what made me strong enough to trust the strategy was like these studies, right? I had my confidence level, my statistical confidence level on the net profit and drawdown that I probably will have before I run on a real account. So informations like this for a trader is more important than the automation, right? The automation is very simple. You can buy, a lot of automation in the internet for around, I don't know, $10. But what's the real gold for quant traders, for automated traders, even if you are not using proper trading firm, is the reference, the statistical reference. If you do not have a statistical reference for your strategies, man, you are blind in the markets, because it's probably some events we're gonna change the pattern of the charts. Even if you don't have any reference to manage your performance, you will be fucking harvest. Sorry for the term, but that's the truth, right? So in this channel, I'm gonna cover a lot of things and insights and tutorials and how you can start with quant trading and apply that for your prop and trade firm challenge or your own real accounts. And also, if to those that don't want to deal with this because find this think this is very nerdy thing, will be solutions for this type of people that see this channel. Okay, so that's the what I want to show you today. Like the video, please comment what you want to see in the next video, the contents, what you want me to show you in this video, in this channel, and let's start.